credit unions were fully engaged at the beginning of this crisis. The vast majority of credit unions doing things like modifying loans, waiving fees, and actually introducing new products and services to help people get to the other end. Jim talked about PPP lending, the tremendous influence that we've had in that market. Almost 200,000 PPP loans, roughly $10 billion in total capital pumped into local economies. And I think he talked about the average size of those loans being roughly $50,000. That's half of what we saw in the for-profit banking sector. So it's really clear from that data that credit unions collectively were focused on small mom and pop operations, Main Street businesses, not professional sports teams, not national chain restaurants and that sort of thing. And that really was impactful. Cornerstone Advisors, the consultancy, has actually done a study, and they showed in their conclusions that credit unions had the biggest jobs impact per million lent of any lender. And that's not just credit unions versus banks. That included the whole arena of lenders that participated in PPP, including online lenders, some of the fintech companies, and so on and so forth. So it's really an amazing, I think, record of accomplishment in a very short period of time. Jim talked about the fact that we've been around for over 100 years, that Congress codified their belief in credit unions and in the credit union difference during the Great Depression, that Congress recognized that we don't just simply have a philosophical difference, a difference in outlook, but basically we have a structural difference that makes a really big difference in the marketplace, and especially during economic downturns. So yes, we were created during the Great Depression by Congress formally. And the reason for that is that Congress policymakers recognized that credit unions actually did behave differently. And so what we saw during the Great Depression was that credit unions remained engaged, that for-profit banks were not lending to average Americans who really needed capital, were not lending to Main Street businesses that really needed capital. And the reason for that, of course, is a structural reason. For-profit institutions with outside stockholders are firmly focused, and they ought to be. They have a fiduciary responsibility to be firmly focused on basically maximizing returns to shareholders. In crisis situations, that essentially means that they're protecting capital. So they're doing their job. In contrast, because credit unions are member-owned, democratically controlled, without outside stockholders, we typically view capital as a war chest to be built up during good times and to be used, not used up, but to be used during crisis situations to get our members from one side of the crisis to the other as quickly as possible and with as little disruption as possible. And that has happened in every subsequent crisis. I've lived through now 3 pretty significant crises: the current crisis, the Great Recession, which is displayed here in this graphic, and the S&L crisis of the early 1980s. And in each one of those instances, credit unions really have stood out head and shoulders above other providers in terms of their engagement in the marketplace, in terms of the difference that they made in people's lives during the toughest of times.